Get on the bull.
S&P 500 program trade by level 1. By level 1.
Wake up call, pal. Level 1. Go to work.
Okay, welcome back to Trading with GB. All right, let's talk gold. If you're watching the screen today, you're looking at that 5,200 level. It's easy to look at that and think, well, great, gold is up, I should buy some. Or maybe you're the cynical contrarian like me. Personally, I think being overly bullish right now might be missing the actual trade. Let's look at the macro bullshit. We've spent weeks listening to the inflation is forever crowd because oil was ripping. Everyone was terrified that the Strait of Hormuz staying closed meant $150 crude and interest rates staying high forever. Then Trump says the war in Iran is winding down, oil retraces, and suddenly the inflation fear trade is dead. Now, normally you'd think lower inflation is bad for gold. But look at what's actually happening. The dollar is softening because the market realizes the Fed doesn't have to keep its foot on our necks with rate hikes quite as hard. What might a pro surely looking at? Here's the reality. Gold is a non-yielding asset. It doesn't pay you to hold it. So, when interest rate expectations drop, even if it's because energy prices are cooling, gold becomes the prettiest girl at the dance again. We are seeing analysts talk about consolidation above the 20-day moving average. Look, technicals are fine, but don't get married to lines on a chart. In fact, stuff like this sounds poorly thought out. How can something consolidate above an average when the average is only going to catch up? Think of the maths. The real floor right now is around 4,800. As long as we stay above that, the bulls are in total control. That 5,200 level, it's a bit like the 100,000 in Bitcoin, both on the upside and the recent slide back through. It becomes an important number to all the media and the punters, although almost always temporarily. If upcoming inflation numbers come in even slightly cool, we're looking at a run toward 5,400. If not, then the risk is a bit similar to what we have seen in crude. You have to ask yourself, what is making more buyers buy? So what is the bottom line? The geopolitical risk premium is being replaced by a monetary policy premium. Gold isn't just rising because of the news, it's rising because the US dollar is losing its edge. But the dollar must keep sliding for gold to keep going. Stop trading the headlines and start trading the reaction. If you're chasing the meaty trade above 5,000, you're late. It's consolidating now. Watch the 4,800 or 5,400 levels for guidance. Meanwhile, let the noise settle. You could argue the market is split down the middle here. That usually suggests options or calendars. But the problem here, of course, is that you have option vols at pretty crazy levels. It's been higher than this, sure, but that was during the GFC and COVID. Ask yourself, are things really that bad right now? Probably not. So don't pay for overpriced fire insurance when you live in a fireproof house. But with an options trade, you can be both the insurer and the insured. Covered plays on falling volatility seem like the move that both covers your ass and takes a common sense position. I used to work with a complete knucklehead of a trader who would occasionally say something with real wisdom. One of his favorites was something like, try to imagine what your perfect hindsight would be in the future. It's almost a Yogi Berra quote, but it's not. It just forces you to take a step back and think about what the logical play actually is. That's about it for today. If you want to dig deeper into more content, head over to tradingwithgb.com. You will find more podcasts plus some serious discounts on the core trading courses if you are looking to level up your own desk. While you are there, make sure you sign up for the newsletter. It is completely free, and it is where I cut through the daily noise and screaming headlines. Until next time, trade on.